Miners are the real thing now. The fundamentals underpin them. The market price is sustainable above $2,500 to $3,000. And the US normal population has begun rotating out of tech into alternatives. Every dollar they sell, 50 cents goes into cash or bonds, 25 cents goes into some safe stock like a utility. And that last 25 cents, a portion of it's going into miners.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning. I'm Vince Lanci, and this is the Goldfix Market Rundown. Today, we're going to be talking about a report from Citi on miners, where they call the industry a once-in-a-40-year gift whose time has come finally. We're also going to be touching on the news last night about China and the U.S. having a negotiation pending and what that has done to the markets since the $145 rally after 2 days. We'll also discuss the price action. Okay. There's the home page. 10-year yields are up 1, almost 2. The dollar is 99.38, offered unchanged. The S&P 500 is 56.44, up 50. The VIX is 24.24, down 53. Gold is 33.87, down 43. Was down 2% at one point. Silver is 32.86, down 30 cents. Copper is 460, down 8 cents. WTI is 59.81, up 60. Natural gas is 348 and change, up 9 bid. Bitcoin is 97,000 and change, up 200 or so. Palladium is 979, up 5. Platinum is 987, up 1 and change. Gold, silver between 100 and 105 now. Soybeans 1041, up 12. Corn 454, up 6 and change. Wheat 454, up 8 bid. We will discuss the price action last night later on in the program. On the front page, we have the story describing the last 2 days. The top left-hand side, that's a post that we had written in January, an original post describing what we thought Trump's plans would be with his Making America Great Again push. And we unlocked it because people are starting to talk about how low oil is what Trump wanted, and it's good for negotiation. Well, that's something that we had discussed in January after reading Scott Bessent's paper from, I think, July of 24. Anyway, it has proven to be correct. Oil is down almost 10% since then. And if you're a contrarian, it almost makes me want to buy oil. Lower left-hand side, and that's that was the morning routine. All right. Miners did very well yesterday, and it reminded us of a slew of reports that we had gotten starting in mid-March. Citi, you can see there, RBC, Bank of America, JP Morgan, and it struck us as positive because miners had not really rallied. So the report that came out before the rally is something that you want to pay attention to. And so we took note of it. Of the bunch, there was a report by Citi, and it was largely a slide deck, very illustrative with important bullet points. And, well, it was a reason that we bought miners. That's how good it was. And we want to go through that again today because if you're a person who's long miners and you're looking for something to make you not panic and sell, you're always waiting to get punched in the face, this will do that. If you're a person who's thinking about miners and looks at charts and says, oh, the miners, look good on a chart, or understands the fundamentals of the market without seeing the catalyst. Well, this report is the catalyst. And what I mean by catalyst is when something's been undervalued for as long as miners have been undervalued, they stay undervalued until there's a catalyst. Now, the catalyst could be an event. It could be a crisis, in gold and oil's point of view, but it could be the banks taking note. And the banks have started taking note to miners, not because they finally realize gold is up and that miners are well run now and that miners have free cash flow now. No, they took note because tech is cracking and they wish to keep investor money in-house. And so they start to tell them this is the next thing to put your money in. Now, we're years from a FOMO situation. What I'm saying is the banks are buying miners now. And that's what I was saying back then, and I'll say it again today. But I think we're close to being in the mainstream. $100 hiccups lower in gold aside, miners are doing better than tech in sell-offs. Miners are keeping pace with tech in rallies. Leadership in the whole marketplace is changing. So, spiel over. Let me go through that report again. This report by Citi we wrote this. This report by Citi is probably the best of the bunch from a macro point of view. They argue, and we write up, at the end of the day, it is time for gold miners to begin to track gold price just like oil and copper producers do. That speaks to us as traditional fundamental analysts. We would add stock portfolio managers like fundamentally driven market analogs with a target, especially when their Mag 7 stocks are cracking. Macro discretionary in gold futures, we've said, likes to hang their hat on fundamental analysis that says the market's going to have buying at this rate for this period of time. Well, the same thing is going on here in miners now. Now, quoting that post that we wrote, the Citi report's primary conclusion is that miners are entering a period of stronger margins. We know that, underpinned by both higher gold prices and relatively controlled cost inflation. However, the analysts argue that despite record margins, miners are not rushing to increase production. This restraint, coupled with the return of strong free cash flow, has strategic implications for investors, sector multiples, and ultimately gold supply. The heart of the work described is this. Number one, this is what stood out to us. That's not the usual miners are undervalued stuff. Number one, miners have been disciplined for years. Gone is the under-hedging or Texas hedging mindset that got them in trouble in the late 80s and early 90s. Gone is the irresponsible spending. Gone is the poor financial management that allowed bullion banks to take advantage of them. I'm referring, of course, to Ashanti and Cambior in 1999. Second, the banks have not paid attention to flashier stocks. It's not a sizzle story like the Mag 7 is. And third, these are our points of view. The investment community, in combination with higher gold prices, is now forcing all of them to take note. And there's what I just said there. And there's one of the graphics showing their points. And the picture there says, the gift for miners is not only based on multiple anomalies, it is unique to gold. There are aspects they get into it there. Let's see if this blows up. Probably not. No, look at that. Interest rates are high. Gold is high. And that means they can capture so much more premium by hedging out 2 years. Miners are locking up free cash flow for a long time. And it's apparent that miners are going to start responding to investor demand. One of the problems that miners have had over the years, going back to when Paulson was trying to steer them, is that miners, they were so disciplined, they were fearful. They were irresponsibly disciplined to the point where they weren't announcing bigger dividends, number one, always worried about the next shoe to drop, not unlike gold and silver investors. And number two, with their free cash flow, they weren't announcing buyback plans. That's going to change. So this information here is just really, I mean, I can't say how good this report is. And Citi is, we don't really see a lot of Citi stuff, but they put out two reports that we've seen in the last 6 months. And one of them was to sell oil to their producers when it was trading 65 and 70, I should say, actually. It cracked to 65 after that. And the other one is this mining report. Okay, so what's my little note there? Oh, yeah, we already said that. We already said that. Okay. Hopefully you're not here for the production value. Data on deck. Wednesday, May 7th, 2 p.m. The Fed meeting is at 2:30. Fed Chair Powell speaks, and at 3 o'clock, consumer credit for March comes out. Related posts to what we just discussed. Here's the other post that came out during that time frame. But there were just so many of them that the Citibank one got lost in the shuffle. Miners, BOA's latest report reveals a massive shift. March 18th. March 28th, miners, there are signs. That's when we took note. We did a piece on that. It would probably be a very good introduction if you're trying to figure out the changing zeitgeist, right? Gold breaks out towards $145. Gold fixed PM. There's our end of day post with a recap of what happened yesterday. And at the very bottom, May FOMC preview, waiting for the storm. If you're trying to get caught up on what to expect from today's Fed meeting, the consensus is nothing will happen. And most of the bank analysts out there don't know what to do. So Powell has increasingly taken a page from Volcker's book, and that is keep the market guessing, let the volatility wring itself out. As long as the bond market doesn't crap out, which it kind of almost did, but now it's doing fine, and we actually have a bull steepening. Unless the bond market craps out, he's not going to do anything. He's not going to do anything to make people comfortable. Okay, so China. I wanted to talk about China. We'll put up the miners here. We're going to talk about miners today, right? Let's quickly talk about China. So yesterday, after the close, Besant announced negotiations will begin in coming days with China. On the reopen, stocks rallied, gold dropped 2%, as we mentioned. I have my notes here. And then China announced more stimulus to support its economy. And so second order thinkers are going, what's the stimulus mean? What's it mean? Well, there's really no gamesmanship when it comes to China. They do what they say they're going to do. And while it is a flex for sure, it's also precautionary. So the market moves themselves are self-explanatory. Gold rallies. This is our note about the market itself. Gold has been rallying incessantly on no news, right? Hopeful news comes out and gold drops into apparently waiting hands of physical buying. Rally, rinse, repeat is the way the market has been behaving. Now, about the China behavior specifically, it should be interpreted just as it is. There are no deals. They assume no closure in one meeting and are strategically unchanged for now. Gold sniffed that out and rallied from down 2% to about where it is now. So a negotiation that's successful will kick a leg out of the gold rally. It will cause stocks to go up. It will make the gold silver ratio drop, believe it or not. And it will necessitate Powell not easing because tariffs would drop, you would assume. And so that's where we are right now. I would have to say, I mean, it's dangerous to interpret, to read into China's behavior, except this. We're going to come to the table. We're going to talk to you. We're going to listen, but we're not going to assume anything. And so we need to take care of our economy. And if it also lets you know that we are taking care of our economy, then we will. The fact that China is still buying gold and hasn't stopped buying gold should tell you more than enough. Final note about that, you'll notice that, just like an editorial comment, you'll notice that in the US, Trump is saying they want a deal badly. Now, China is saying the US asked for the meeting. Now, both are lying and both are telling the truth and both are playing to home audiences. In US partisan politics, it no longer is about trying to change people's minds. It's just about trying to keep people on your side that are already on your side. So if you're a Democrat, you just, speak to your audience. And if you're a Republican, you speak to your audience. That's international now. Trump isn't speaking to China because our message doesn't get through to China. The people, most of them don't speak English, and those that do probably aren't really able to hear it in the context that it was said, that Trump said. Conversely, in the US, if you don't think that we have our own version of a Chinese wall up, well, then you're mistaken. It did get through that Xi said we wanted the meeting, but it won't be covered. So that's pretty much it. All right, so let's go to the charts here, GDX. The two red lines are the time frame when I got all these reports about gold miners, and we covered them, and I actually bought some. And then, of course, the market dropped, and all of us said to ourselves, oh, here we go again, recommend the miners go down. But that wasn't miner-based. And look at that V-shaped bottom, not a dip and sideways and rolling off tables, and then look at what happened. It's a different market, guys. This is gold, 2 years ago. Moving on to the actual gold chart. Those two yellow lines, that's the channel I described. And my general simple comment is this. The ledge held, right? Here, we'll take out a little drawing tool. We'll do a little Bob Ross stuff. Physical buying, macro funds sell it, macro funds cover, momentum funds get long. That's what this is right here, okay? Be careful, obviously, but as long as the market does not settle below my yellow line, then I'm going to be comfortably long. The market settles below the yellow line, then I'm going to assume we're going to have another one of these. If, however, news comes out, it'll probably go below here, because if I'm a physical buyer like China is, or other central banks are, I'll just lower my bid if the market starts to crap out on a news item. So as of right now, it had its first test of my yellow line, and it withheld it. Let's take a look at that from an hourly point of view so you can see what I'm talking about. And I'm going to throw poly up there. So there's an hourly. There's those two yellow lines I told you about. Look, penetrated it on the news, right? Okay. That's an algo buying. And there's the poly levels. Poly levels are very crowded on the 1 hour, which says you really shouldn't look at it. There you go. I mean, the 4 hour is actually a pretty good looking chart. You want to, again, another ledge. The question is, yeah, so poly's basically saying it doesn't have a line where I do, but it basically says below yesterday's high, we should test down to looks like 2 days ago's high. All right. So to recap, let's bring the miner chart up again. We'll zoom out a little bit, give an idea of how far miners have come. To recap, miners are the real thing now. The fundamentals underpin them. The market price is sustainable above $2,500 to $3,000. That's all they need for this to remain profitable, according to the Citi report. And the U.S. normal population has begun rotating out of tech into alternatives. Every dollar they sell, 50 cents goes into cash or bonds, 25 cents goes into some safe stock like a utility, and 25 cents, that last 25 cents, a portion of it's going into miners. And such a small market, you don't need much of it to go into miners to have it have the effect that you want. We're years from a bubble. Okay. I'm Vince. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lancy. Sure hope you enjoyed the show. And real quick, before we wrap up, did have some news to pass along from Fortuna Mining, who was our proud sponsor of today's show, as they have renewed their share repurchase program. That's something that they were active in last year. And that share repurchase program now has been renewed. Obviously, something that Jorge Ganoza, CEO of Fortuna Mining, has talked about quite a bit in terms of strengthening their balance sheet. And that is one of the ways in which they have done that. Also, some other recent news that fortunately we'll get even more color on soon, because Fortuna did recently announce the sale of the Yaramoko mine in Burkina Faso and also completed the sale of the San Jose mine. And fortunately, they have earnings coming up. Will be released on the night of May 7th and hit the market on May 8th. And we'll be having Jorge join us for a call where we can take questions and dig into all those things. So that will be Thursday. Of course, you can always find out more at fortunamining.com. And certainly it will be fun to see what the earnings look like with the once again elevated gold price in the first quarter. So again, that call with Jorge will be Thursday, May 8th at 4:30 p.m. Eastern here on the Arcadia Economics channel. And we'll look forward to seeing you then. So go out, have a great day, and thanks for being here.